Earning your first $1 million before the age of 30 is not a matter of luck or financial miracles. It is the result of the right mindset, consistent action, and smart decisions repeated over a long period of time. In reality, people who reach significant financial milestones early rarely follow a get-rich-quick path. Instead, they focus on building a solid financial foundation from an early age. This article does not promise shortcuts. Rather, it shares core principles that can increase your chances of building substantial assets, including the goal of reaching $1 million before 30, or at the very least, put you on the right financial trajectory. 1. Develop the right money mindset. Money is a tool, not the destination. A common mistake among young people is treating money as the ultimate goal. In truth, money is simply a tool that buys time, freedom of choice, and flexibility. When you focus on creating value for others through skills, products, or services, money becomes a natural byproduct. Instead of asking, "How can I make more money?" ask, "What problem am I solving? Can the value I create be scaled?" Learn to manage money from the smallest income. There is no strong financial foundation without control over personal cash flow. Financial management should begin with your very first income, no matter how small it is. People who build significant wealth early typically know how much they earn, know where their money goes, and know how much is allocated to saving and investing. Create a clear and measurable financial plan. Specific goals matter more than the $1 million number. $1 million is just a number. What truly matters is what you want to achieve with that amount of money and whether your assets come from earned income, investing, or business. Instead of vague goals, break your plan into stages. Years 1 to 2, build skills and initial capital. Years 3 to 5, increase income and diversify revenue streams. Years 5 to 10, focus on investing and income-generating assets. Saving is the foundation, investing is the lever. Saving helps you survive, investing helps you grow. A healthy financial plan typically includes reasonable spending on essential needs, consistent saving, long-term investing with a clear strategy. The goal is not to get rich fast, but to let your assets grow steadily over time. Build income skills and use leverage wisely. Don't rely on a single source of income. One common trait among early wealth builders is that they don't solely rely on a salary. Income can come from professional skills, freelancing, services, small businesses, long-term investments. A second income stream doesn't need to be large at first, but it helps you accelerate wealth accumulation, reduce financial risk, and expand future opportunities. Investing in yourself offers the highest return. Skills, knowledge, and experience are assets no one can take away. Continuously upgrading yourself allows you to increase your earning potential, access more career options, reach higher income opportunities. In the early stages, investing in yourself matters more than investing in financial markets. Use financial leverage with control. Financial leverage, loans, partnerships, can accelerate growth, but it is also a double-edged sword. Use leverage only when you fully understand the risks, your cash flow is stable, and you have contingency plans. No large asset is built on reckless risk-taking. Invest for the long term and diversify. Start early to benefit from compound growth. Time is the greatest advantage young people have. Starting early allows you to benefit from compound returns, avoid excessive risk-taking, maintain long-term stability. Diversify to reduce risk. A balanced investment portfolio may include stocks, ETFs, real estate, investment funds, a small portion allocated to higher risk opportunities. Never go all in on a single asset class. Patience matters more than luck. Markets are always volatile. Successful investors are those who stay disciplined, don't panic during downturns, Adjust strategies instead of giving up. Maintain financial discipline and build strong networks. Live below your means. This doesn't mean living miserably, it means spending intentionally. Every financial decision should support long-term goals. Track and adjust continuously. Personal finance is not a one-time plan. You should review your finances regularly, adjust as circumstances change, learn from mistakes. Your network is an invisible asset. Major opportunities often come through people. Building strong relationships helps you learn faster, expand your perspective, access opportunities earlier. Common mistakes to avoid: lacking a clear financial plan, investing based on emotions or trends, overspending and losing control, expecting results too quickly. Conclusion: reaching $1 million before 30 is not a goal for everyone, but building a strong financial foundation early is entirely achievable. When you follow the right principles, stay disciplined long enough, and continuously invest in yourself, major financial milestones become a natural outcome. This article is for educational purposes only and does not constitute financial advice. All investment decisions involve risk and should be considered based on individual circumstances.